Hello, it's Rhonda Thomas, and we're ready to do Financial Accounting Chapter 9 intro exercises. So let's go ahead and share the screen. So, share the screen. Okay, I am in the problems now. Cengage. I'm in Cengage, and I have my spreadsheet open. And this is the last asset that we're going to look at more in depth. And this is going to be fixed assets. A fixed asset. So fixed assets are assets that you plan to use for longer than a year. And the only thing that depreciation means is that you're expensing and one of these fixed assets. You're expensing one of these fixed assets. So if you take most of the time initial cost, subtract any residual value, you get a depreciable cost. Depreciable cost is going to be spread out over the next 5 years, which is its useful life. Okay, so a fixed asset has a debit balance, and then it has a contra asset that goes against it, uh, similar to the allowance in accounts receivable. Okay, this accumulated depreciation will always go with that fixed asset, and you must gap one. There is no choice about whether you use accumulated depreciation or not. When you have a new depreciation expense account, now there are three methods that we're going to work on. There are two methods of keeping the balance in let me see here. Hold on this one. Okay, nope, there are two ways to do. You're going to get a little confused here. Just a second. All right, let's just go with this one. So we go three different cost flow methods. Here we go. Cost flow method. This is a really good chart in the book. We're going to work with straight line, units of activity, and double declining balance. Okay, so, and then here's a nice comparison of straight line, units of activity, and double declining balance. Okay, and all right, so let's go ahead and get started. So the first one and the easiest one is straight line method. Okay, straight line method. Straight line means you're going to have the same amount of annual depreciation every year unless something changes. Okay, so our fixed asset has, our fixed asset has $1,481,350. It does have a residual value. Residual value means how much it'll be worth after its estimated useful life. Okay, so we got to put that in. And that will give us the depreciable cost. Depreciable cost. So that's the first thing we want to know. Let's see what we got here. And then the useful life is 20 years. So how you find the straight line rate is you take 1 over the useful life. Okay, so in other words, this is going to be 1 divided by 20, and you get 5%. Okay, 5% is the straight line rate. What that means is for the next 20 years, you're going to depreciate 5% of the depreciable cost. Now, if this residual value was 0, then the building value and the depreciable cost would be the same, but this is not 0. If you do get 0 residual value, be sure to just put 0 in so that you know that you have looked for it. All right, so now we're going to take the fixed asset minus the residual value divided by the number of useful life, right? Useful life in years. Okay. But useful life years. Usually, yeah, it's going to be beyond a year. So let me show you what this is going to look like. Okay, so 1,481,350 minus the residual value, which is 103,150 divided by 20. So, if I got this here. Yep. All right, so it looks like every year for the next 20 years, if nothing changes, we will be doing an adjusting entry, right, for $68,900. And then it will go in here, $68,900. Okay. I want it. Okay, here we are. So here is the amount of the depreciation. Okay, so the depreciation for this first year is $68,900. So we'll make an adjusting entry at the end of the year for that amount. Okay, and that will equal that. And then we'll have the book value. Okay, this is what the book value of this asset will be. Book value. Book value is the fixed asset minus, okay, so it'll put fixed asset minus accumulated depreciation. Okay, and knowing the book value of an asset will help with when we sell it. Okay, when we sell it. So the annual straight line rate is $68,900. Okay, so that is straight line. Let's go to another one. Now let's go to units of activity. All right, so a lot of times units of activity is for a piece of machinery or equipment. In this case, it's a truck. Okay, so a truck is acquired for $67,700. Okay, so we're going to put that amount here, $67,700. The amount of the residual value is $7,000. Okay, its useful life is 303,500 miles. Useful life. And so now we've got to come up with a rate. Okay, a rate. Find the depreciation rate. Okay, so we use the same, so the depreciable cost, right, is the cost of the truck minus its residual value. So let's put that in, right? And then the units of activity take 2 steps. We have to find a rate, and then we have to apply that rate to the actual mile. Okay, so if we take our depreciable cost, divided by the number of miles, amount per mile. Depreciable rate is 20 cents a mile. Okay. Then we need to know how many actual miles were driven for the first year. First year, 9,700 miles were driven. 7 miles. So here is the first year of depreciation for units of activity. So units of activity will give you various amounts. Usually first year is the most depreciation because that is new. So the units of activity depreciation is going to be 1940. So then we would do an adjusting entry, 1940 here. Even though they're not was units of activity. 2 steps to it. Find the rate, the same depreciable cost as straight line. So you divide, find the depreciable rate, and then you take it times the actual miles or the actual hours. Okay, all right. And then this next one is double declining balance. Okay, double declining balance. So this asset is a building, 1,252,000. Okay, is estimated residual life, estimated residual value, sorry, 87,600, and the useful life is supposed to be 40 years. Okay, so the first step for double declining balance is to find the straight line rate. Okay, I know we're not using straight line, but we have to know what it is so we can double it. Okay, so we can double it. So 1 divided by 40 is 2.5%. And when that gets doubled, the double declining rate is 5%. Okay? The double declining depreciation for the first year. So then you have to make a little table, okay, and you put the cost of the asset, and you do not subtract the residual value. You do not at first. So we're going to take 5% of that, which gives us $62,600. Okay, so $62,600, and then that would be the first year. Okay, then you have to bring your book value. So the book value is the cost minus that depreciation amount, which is the book value. Then the next year is going to be 59,470. See how the balance, see how the depreciation is declining, right? The year before it was 62,000, and now the third year is even less. So this is called accelerated depreciation, and each year is going to be a little less and less until you get down to the last year. This is a 40-year useful life, so it's going to be a while. So yeah, but the double declining depreciation for the first year is $62,600. Okay, so those are the three depreciation methods, and you can use whichever one you want. GAAP doesn't mind, just as long as you keep a record of which depreciation method you're using. And if you change it, I think you have to give an explanation. And there are other depreciation methods, but we're just going to work with these three. Okay? Well, sometimes fixed assets, something happens to them. Either they have to be repaired or their depreciation turned out to be something different. So what do you do if you have to revise depreciation? So equipment with a cost of $967,900, $967,900, right, has a residual value of $95,900, estimated life of 20 years, okay, estimated life of 20 years, and is depreciated by the straight line method. So determine the amount of the annual depreciation for the first year. Okay. Determine the amount of the annual depreciation. So, okay, amount of the annual depreciation. Let me see here. Okay, so it looks like it is $43,600 for 1 year. $43,600. Let's check. That's right. Okay, now determine the book value at the end of the 9th year. All right. So let's put year 9 here. And if you have the same amount of depreciation each year, you just need to take it times 9. The amount of depreciation times 9 equals $392,400, and the book value, okay, the book value now, got everything in the right spot. So book value is the cost, it's right here, minus the accumulated depreciation as of year 9. Okay, so it looks to me like the book value at year 9, after 9 years of depreciation, is $575,500. Another explanation for book value is that's the remainder of the asset to expense. Okay, let's see. Now we're going to revise our depreciation estimate. Just a minute. So we're sitting at a cost of $575,000. They have estimated that the new useful life is 17 years, and residual value is $77,400. New useful life is now 17. So this is going to get revised. So once again, we're going to just use the straight line rate just like we were doing it for the first time. Divided by 17. Divided by 17. 29,300. Assume determine the depreciation expense for each of the remaining 17 years. It looks like it's going to be 29,300. Okay, so sometimes things get revised, right? Initially, we thought it was going to be 20-year life. Then after the 9th year, beginning the 10th year, we realized that that asset had another 17 years. not just over 11 years. So sometimes that changes. Okay, next exercise is comparing a capital expenditure and a revenue expenditure. So here is the explanation. So a capitalized expenditure is included in the fixed asset account because it adds value, usually a larger cost, abnormal, extraordinary, and usually infrequent. But a revenue, its extended useful life costs are debited to accumulated depreciation. Okay, so extended useful life costs are debited to accumulated depreciation. Okay, so debiting accumulated depreciation means that we are actually taking some expense back. Okay, so we'll work this out here in just a minute. But a revenue expenditure is just a normal, ordinary, frequent cost or expense. Okay, so please don't get too hung up on this. This is an expense. And then, so let's see here. On February 13th, GPS company paid $1,860 to repair the transmission on one of its delivery vans. Now here is the key word, repair. If that said replace, then that would be a lot more probably than that. So this is going to be a repair. Okay, so it's going to be a repair. And, all right, so February 13th for the transmission is going to be, I don't think I, oh, hold on just a minute. All right, so we want repairs and maintenance expense. Let's put that here. Repairs and maintenance expense. Should be 1960. That's right. Okay. Actually, um, this is actually going to, okay, all right. This is actually going to, I had this right the first time. Okay, this is a delivery van. Sorry about that. So that's going to go up here. Cash is good. So it's not going to go in repairs and maintenance expense, which I thought it would. And I think this has been a change because this is something that I don't remember. So we're going to debit this for the transmission. I believe is what we have here. Let's try this again now. Yep, yep. Sorry about that. So do not put that there. Now, because that's quite a bit of money, right? That's quite a bit of money. So we're going to, um, once again, capital expenditures are the costs of acquiring fixed assets, adding to a fixed asset, improving it, or extending a life. Expenditures are ordinary maintenance and repairs are expense as they are incurred. Okay, so this really didn't get expense. This is, um, anyway, extended useful life. extended useful life, so that repair of the transmission. Now, if that would have been an oil change, okay, if this would have been an oil change, we would have put it in repairs and maintenance expense. So I am going to put that there just in case you get tempted. So now the GP is going on. GP is $230. And so GPS makes the vans more useful, right? Makes them more useful. So they're going to add to the fixed asset of the delivery van at 230. Okay, sorry about that. I think I was muted. I was just saying that some of this is subjective based on businesses. Some businesses choose to capitalize an amount above a certain amount, maybe above 2,000, above 3,000, whatever it is. And they do have to go by the rules of GAAP. Okay, but the other reason why we're trying to figure out all this book value stuff of the book value of these assets is there are occasions that we sell them. Okay, and when we sell them, we have to keep this fixed asset intact, and we have to keep this one intact, so that when we get ready to sell it, we'll see if we have a gain or a loss on the sale. So this is what we're getting ready to do. Okay, there is a set of rules to get to. So here you are. Okay, so this is the sale or disposal of fixed assets. Okay, so the cost, the equipment acquired at the beginning of the year is $590. Its residual value is $9,000. Okay, so its useful life is 10 years. So the straight line rate is 10%. Therefore, the double rate is 20%. So you don't subtract the residual value. You start with the cost. Okay, so the cost is 590, and then the double rate, the double of the straight line. Okay, so what's the depreciation for the first year? It's $118,000. Okay, $118,000 is it. So assuming the equipment was sold at the end of the second year, and that's another thing. You have to watch the timing of, is it the first of the year? Is it the end of the year? Is it the fourth of the year, 3/4 of the year? You got to know the timing of the sales, and you got to know the timing that an asset was put into service. All right, so assuming the equipment was sold at the end of the second year for $440,000, determine the gain or the loss on the sale of equipment. All right, so here we are. Okay, let me take this out. So the first year is $118,000, and the second year is $94,400. So, all right, so we brought that up to date. And here's how you do a sale. Steps for selling fixed assets. First, you update accumulated depreciation with regards to sale date. So they're selling this at the end of the second year, so we would have already figured our depreciation. So then, okay, so then what we have to do is, let me see what the book value is. Book value is 590,000 minus its accumulated depreciation. So you're looking at the book value, 377,600. Now, our proceeds. Here's the thing we want to do. Proceeds. Okay, how much are the proceeds? How much are you selling it for? Sales proceeds. Let's put that amount here. That is 440,000. And so here's what's going to happen. The book value is less than the sales proceeds, right? So here's the rule. When this is this way, right? So the book value is smaller than, I can get that in here, smaller than, when the book value is smaller than the sales proceeds, you're going to have a gain. Okay, you're going to have a gain. So I'll show you how. This will work. Okay, so results in a gain. Results in a gain. Gain on the sale of the asset. Okay, so put your proceeds in. Okay, so proceeds equals what this is. Okay, you've got that much coming in. It's a debit. Okay, you're going to debit this account for however much is sitting here. Okay, you're going to credit this account for however much is sitting here because you're selling the fixed asset. Okay, every time. Okay, so then a gain is going to happen. A gain has a credit balance. Okay, the gain has credit balance. So the gain is 62,400. Now let's see if this works. So assuming, so this is going to be a gain. Okay, so selling at a gain is a good thing. All right, and then there's the amount of the gain. How did we know we have a gain? Here's the rule. If the sales price or proceeds are more than the book value, then you have a gain. In this case, I have it backwards as far as where they're at, but the greater than is here. If the sales price is smaller than the book value, you'll have a loss. A loss, okay, so a gain has a credit balance. Credit normal balance, and a loss has a debit normal balance. Let's do the recording of that. Let's bring those proceeds in. Okay, the proceeds are the amount we sold the equipment for, which is 440,000, and then we had to debit accumulated depreciation for the amount that's in there. We had to get rid of the asset. And then finally, we book the gain. Gain on sale of equipment. sorry. Zoom kicked me out again. So we're back. All right, and we just finished the sale of this asset, and it resulted in a gain because the proceeds or the sales price is bigger or larger than the book value. Okay, so we got three more here. We'll see if we can get these done. Okay, now this is depletion. Okay, depletion is for a natural resource. All right, so if you had mineral rights, 81,250,000. Okay, the mineral deposit is estimated at 65 million tons. Okay, so I'm going to put those tons here. 65 million. And how much is predicted to be in that mineral deposit? During the year, 14,300,000 tons were mined and sold. So depletion is just another word for expense. It's expensing a natural resource. Determine the depletion rate. So just like we found the rate in units of activity, we're going to find the depletion rate. So the depletion rate is the dollars for the mineral rights divided by the number of tons. So depletion of tons is $1.25. Every time we extract a ton, then we depleted our mineral rights by $1.25. Okay, so then the first year, we depleted, right? It says 14,300,000 tons at 125. That is 125. So it looks to me like the depletion for the current year is 17,875,000. Okay, and journalize the adjusting entry to recognize the depletion expense. The depletion is going to be that much. Okay, so it's going to have accumulated depletion, and we're going to have depletion expense to offset each other. So it's going to go in the depletion expense account. And then accumulated depletion, 17,875,000. Okay, there it is. There's the adjusting entry. Just like we would do depreciation. Okay. Next one is intangible assets. Hang on just a minute. I think we need this to be 9.8. Yeah. 9.8. We can have assets on our books that are intangible, such as goodwill, patent, trademark, copyright. So tangible is physically exists. Intangible is exists only on paper. And instead of the word depreciation or depletion, we're going to use the word amortization. Okay, amortization. So on April 1st, okay, so that's not January 1st, a patent with an estimated useful economic life of 12 years was acquired. So acquired means purchased $57,600. So this is April 1st, $57,600. Okay. All right. Journalize the entry to record the acquisition of the patent. Okay, so this is going to happen here. All right, so we're going to bring the patent in to its own account. Just like any other asset, it's going to have a debit normal balance and pay cash for it. Okay, so journalize the adjusting entry on December 31st for the amortization of the patent rights. The patent rights. The patent rights. So down here, okay, and then we need by here by 12 years. Okay, so C4. So $4,800. Now be careful. This is a partial year. And this is a partial year because we got this on April 1st. So 3 months had already passed in the year. So we had 9 months to go. So we're only going to show amortization expense of $3,600. And it's going to come directly out of the patent. Okay, so I know this is different. We don't have an accumulated amortization account to go against these intangible assets. So it's going to get amortization expense, and then the patents will go down. Okay, so they don't have a contra asset for intangibles. Okay. All right, and then finally, the impaired goodwill. Okay, goodwill is kind of like your reputation as a business. Okay, so it says in December, in addition, on December 31st, it was estimated that our goodwill was impaired. Okay, impaired. Well, we're going to have goodwill as an intangible asset. I don't know how much it was worth, but somehow we're losing $50,700. Okay, so when you have 12 that's incurred, you simply make the asset go down by the amount of the impairment, and then there's an account called loss from impaired goodwill. Okay, so it's going to be a loss when that happens. Okay, so we're going to debit the loss from impaired goodwill, and then we're going to make that goodwill go down. Now, we don't know how much the goodwill is worth. It doesn't matter. We're just going to record the impairment. And impairment means that something has happened to our reputation as a business. Suppose if this increases, then it would be a gain of goodwill. So I know goodwill is pretty controversial because sometimes it's hard to pinpoint goodwill down as to how much it is a business's reputation type of thing. And so, yeah, I've just heard about goodwill. I've never worked with it myself, but once again, the impairment is $60,500. All right. So this last one is fixed asset turnover ratio. Okay, we're going to look at the last one here. Okay, so let's put our year 4 in. Okay, looks like fixed asset turnover ratio. So how often we are using our fixed assets. All right, so we're going to have sales, and I've got year 4, 1,121,000. Okay, in the beginning, fixed assets 550,000 and 630,000. Now we need an average of those fixed assets, and then we're going to take. So then this number is sales divided by the average fixed asset. So then year 4 gets 1.9. 1.9. Now let's do this side. The sales for year 5, 1,506,500. Yep. Okay. So the beginning fixed assets 630,000 and 680,000. All right. So now when the math is done, 30. 2230. So if you're using your assets more quickly, okay, that means that you are growing. Okay, you're growing if you use them more quickly. Turning them over means that you got to replace them, okay, or you're using them up. So there is that. Okay, I think that's it. All right, that's it for Chapter 9's intro exercises. I will see you on the next video.